Okay, folks. I mentioned this last class, but I will mention it again. If you did not pick up your quiz, it was out there for 4 days. It's now in my office. So if you want to come pick it up, you're welcome to. There are about 50 quizzes left, so quite a few of you have chosen not to see it. No, but it's not going anywhere. And the scores are recorded. It's nailed in. But again, it's just one quiz. If you did badly, just let it go. So today I want to put in the closing pieces of intrinsic valuation. We talked about discount rates, we've talked about cash flows, we were talking about growth. And I want to finish up that growth discussion. And what I'm going to say in the first 20 or 30 minutes is more related to your company valuation than it is about just getting the concept right. So as I talk about growth and margins and reinvestment, I want you to think about your company and say, what would my thinking be on my company to come up with the numbers? Okay. I'm then going to deal with the elephant in the room, which is that biggest number in every discounted cash flow valuation, which is terminal value, right? You look at the numbers, it's going to be 8, 10, and on one level, that's one reason people don't do discounted cash flow valuations. The terminal value is such a big, what's the point, right? We'll talk about what the point is. But at the same time, I also want to talk about putting guardrails on terminal value. So today's start of the class test is about that elephant in the room, the terminal value. So you've estimated cash flows for the next 5 years, the next 10 years, you get to your 5 or 10, you put in a terminal value. I'm going to list out 4 different ways you can get the terminal value. And I'm going to argue that one of these should never, ever, 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 ever be used. I think I've made myself emphatic enough. And I want you to tell me which of these 4 should never be used in an intrinsic valuation. The first is a liquidation value. Is that consistent with an intrinsic valuation? Why not? Isn't it a cash flow?
Well, it's kind of a fire sale situation.
But in some companies, isn't that? So let's say you're doing a royalty trust, right? You get oil out of the ground. At the end of 10 years, what's left is going to try to sell whatever physical equipment. It's the nature of the business model. You're valuing a business where there's a key person involved. That key person is 70 years old. Person dies. So liquidation value might not be your preferred way of estimating value, but it is a cash flow, and for some companies it fits.
Realistic, yes.
So liquidation value, fine. Some companies, you don't use it for. What about a stable growth model, where you assume a growth rate in perpetuity? So what do you do? If you said no on this, we kind of have to go back and re-examine, because this is how almost everybody who does discounted cash flow valuation does it. And I think they're too rigid about this. And to explain why, let's look at the third choice. Can I get to year 10, and rather than assume cash flows continue in perpetuity, which is the standard assumption, can I assume the cash flows continue for only another 15 years? So growing annuities in terms of present value. Or it could be, again, in the case of Aramco, there's 50 years of oil left in the ground. And you might say, look, I get to year 10, I'm not going to be estimating year 11, year 12, because it's going to be 2% growth for the next 40 years. It fits, you can do it. The fact that we don't do it suggests how rigid we've become about assuming that every company grows in perpetuity. I kind of have given you the answers to which of the 4 approaches should never, ever be used. Liquidation value is okay. Stable growth model is okay. A growing annuity is okay, which leaves us with what? An exit multiple. You know what an exit multiple is? Somebody help me out here.
Just when a smaller company reaches the maturity and
But nothing to do with small or large. In fact, in banking, 80% of valuations, the exit multiple. What is it? So you get to year 10, you take the EBITDA in year 10, you apply 8 times EBITDA, you got your terminal value. Where do you get, in most cases, where do they get the 8 times EBITDA? And the comparables, and basically it's a pricing, right? You've taken your biggest number in your intrinsic valuation and made it a pricing. It's no longer an intrinsic valuation. I call these in DCFs and drag, right? You're distracted by the cash flows in year 1, the discount rate in year 2. When the biggest number in evaluation came from a pricing, it's a forward pricing masquerading as a discounted cash flow valuation. 80% of banking valuations, almost every M&A valuation, the terminal value is based on an exit multiple. These are not DCFs. Why call them DCFs? And you can see why. With an exit multiple, you're always going to get a pricing closer to the current price. Why? Because it's almost circular, right? Use pricing to justify pricing. Of course, it's going to work better. And if your job is to get transactions done and pricing is your preferred choice, you're going to make your DCF into a pricing. So we're going to come back and look more at the first 3 choices, but clearly you have choices. Let's assume you're valuing a company, you get to year 10, you get your expected after-tax operating income of 100 million. So the company is making in year 10. Let's assume this company has a 0 growth rate in perpetuity, which is perfectly okay, right? 0 is a number just like 2 or 3%, 0% growth rate in perpetuity, and a cost to capital of 10%. Very simple calculation, don't need a calculator. What's the terminal value for this company? $1 billion, 100 million. But that's earnings, right? How come I'm able to discount earnings at the 10%? I added the cash flow, but even if I hadn't told you that the cash flow is equal to the earnings, what is it about this company that allows me to use earnings as cash flows? No growth. No growth, no reinvestment. No reinvestment. I can effectively assume earnings, so the terminal value is $1 billion. Let's do some value magic here. Let's assume I allowed you to use a growth rate and you put in a 2% growth rate in perpetuity on this company. Go with your gut, tell me, what do you think will happen to terminal value with the 2% growth rate? Lambert, what do you think will happen?
It could go either.
But mathematically, it looks like without looking at the reinvestment question, if I just put in growth, of course my value is going to go up, right? I try a 2% growth, it goes to 1.2. I try a 4% growth, it goes to 2. So already you can see that if you allow for growth without having to reinvest to generate, of course growth is magical. And I think you've answered the question of why that is not a good choice, because if I put in a 2% growth rate, I can no longer use after-tax earnings as cash flows. I have to figure out how much I would reinvest, and that'll depend on what kind of returns on capital I can make on investments. And once I bring that in, you're absolutely right. It can go up, it can do nothing, it can do it down. And one of the things we're going to talk about is what is it that separates companies into those 3 groups? How do you make that part of your story? Because that's going to drive what your terminal value is. So we're going to get to terminal value, but first I want to go back and finish up that discussion of the 3 big inputs. Last session, we talked about revenue growth. I hope you've had a chance to think about revenue growth for your company. Look at the size of the market, size of the company, competition, all that stuff plays in. So you come up with a revenue growth number. Second stop, I'm going to ask you, what kind of margins will this company make? Not right now, but in steady state. So let's look at some of the things you're going to look at to make a judgment on whether to give your company a 40% margin or 10% margin. First and biggest factor is unit economics. Fancy buzzword, but what does that mean when I say unit economics? A company has good unit economics and bad unit economics. What are we talking about? Guillermo? What is unit economics measure?
The marginal cost of producing one more.
Or when I sell an extra unit, what does it cost me? Let's take 2 contrasting examples. You buy an extra copy of Office on Microsoft's website. That's $89.99 if they sell Office directly. I don't know whether they do. Maybe you have to get Office 365 now. But let's say you can buy Office, $89.99. That's a revenue. How much did it cost them to make that extra copy for you? If you've been operating under the delusion, Microsoft actually makes a specialized copy for you when you order it, it's not happening. It costs them nothing. And it costs you nothing. What does it mean? In steady state, your margins are going to be 40, 45, 50%. It's the reason NVIDIA's margins are so much higher than every other semiconductor company. What sets them apart? They don't make their chips. There's no factory, there's no production. They design the chips. They're more like an Airbnb for semiconductors, though they add more value than Airbnb, obviously. So you're going to look at unit economics. In contrast, if you're the greatest car company, the most efficient car company in the world, your operating margins can never be 40% in steady state. Think about that the next time you see an ARC, you've heard of ARC, right? Kathy Woods, and they turn out what they call an intrinsic valuations of Tesla every few months. It's good for laughs, nothing else. You'll see numbers like 80% EBITDA margins. That's this, I mean, when you build a spreadsheet and you actually don't even think about what does it cost to make a car, you can make up any margins you want. Tesla's margins can never be 80%. In fact, part of what happened in 2023 that freaked people out is Tesla's automotive business started to have margins very much like an automotive. Surprise, we never thought that would happen. If you're a manufacturing company, your target margins are going to be constrained. So already I want to think about your company's business model and unit economics. Second stop, economies of scale. Here's the difference between unit economics and economies of scale. Unit economics you will see in your gross margins. So when you look at your company's financials, even if you have a young company that's losing money, your gross margin should be healthy if it has good unit economics. Economies of scale show up between the gross income and the operating income. So what are the items that come in between gross income and operating income? SG&A, R&D, and every company claims to have economies of scale, right? I've never heard a company say we have no economies of scale. They all claim it. Many of them are lying. And how do we know they're lying? It's an easy test. Look at their past growth in revenues, look at their past growth in SG&A and R&D. And this was my problem with Uber for the longest time. Until about 2 years ago, there was absolutely no economies of scale showing up because their expenses kept rising at a rate faster than their revenues. But if you believe your company has economies of scale, that's where it's going to show up. And competition. Yeah, go ahead.
If a company sells more than one product for the unit economic metric, you need to
look at the
product line, or
either that. If you want to do it by product line, you're going to do the valuation by product line, because then you have to have 4 line items for each product line. And I did that for Tesla, right? Basically, I had automotives because the software business. So if you feel you're in multiple businesses, then take the revenues, and for each one, you'll have 3 different storylines running through your company. Now, for each business, you'll have a different storyline on growth and margins and reinvestment, but do it only if the businesses are different enough that it's worth doing. Okay. Never add detail if you don't think that detail will help you tell a richer story. And competition. I'll tell you why competition is such a big ignored factor. You'll see somebody valuing a company, they'll say there are big economies of scale in this business, the costs are going to come down. And now, of course, AI is added to that story, right? With AI, we'll bring our costs down even more. Therefore, our margins will go up. You know what the missing piece in that story is? You're a grocery store or you're a manufacturing company, you bring AI in, you reduce your costs. This is good news. But if everybody else is bringing in those ingredients, remember, you're not the only customer for these products. They all bring their costs down. This is where competition kicks in, because if you have competition and everybody's costs go down, your margins are not going to increase. They're going to actually scale down because you charge lower prices. So all those factors will play into your target margin. So I want you to start thinking about, in my company, will the target margin be 50%, 30%? This is going to be your one biggest ingredient that drives your value. What do you think your margins will be in steady state? I'm not suggesting it's easy to do, but it is going to be a key driver. Now, as a subset of this, I'm also going to ask you, let's say your margin right now is minus 10%. When will you get to the target margin? Which is just a fancy way of saying, tell me what the pathway to profitability looks like in your business. Is it rocky? Is it smooth? Is it quick? And the answer to that will depend on, first, what you're starting with. You're starting with minus 75% margins right now. you probably are looking at a much more rocky pathway because you're deep in the hole. You're starting with -3%, the trend lines are in your favor. It's going to be much quicker. Second, I mean, it also depends on what the company is trying to do. What does that mean? If a company is focused on profitability, it's going to behave very differently than if a company is focused on growth. In fact, I would argue the last decade, we rewarded companies for scaling up and did not reward them enough for building business models. So guess what they did? They listened and they scaled up. They became $100 billion companies without even thinking about how do I make money in this business? So look at the company's behavior. Is it a company that's focused on growth or margins or profitability? Because that's going to determine whether you move there quickly or not. And finally, it depends also on the business model you have. Do you have a business model that actually works? You'd be surprised how many publicly traded companies that trade in the tens of billions of dollars haven't quite figured out how to make money yet. And again, I hate to pick on Uber, or I love to pick on Uber. I mean, how does a company, an entire business like the ride-sharing business, get as big and how does a business get as big as the ride-sharing business? Hundreds of billions of dollars disrupt the entire car service business without anybody in the business figuring out. It's not just Uber, right? Uber can't make money, Lyft can't make money, Didi loses money like it's going out of style. Grab doesn't make money, Ola doesn't make money. This is not a company-specific one. This is a business problem. So if you have a business model that doesn't work, you need to figure that out. That'll take longer to do. So while every company likes high margins, David?
So why did you stop?
Because I think it got priced at, when I bought it, it was in 2020, if you remember. And the reason I bought Uber is where are we going to go, right? So until we're in a sense stuck in a dance with these disastrous companies because we have no alternatives. The taxi cab business is dead. It's not coming back. So I think, unfortunately, until Uber and Lyft figure out how to make money, they're going to continue to lose money. But eventually, in my story at least, they figure out how. And it's not going to be good news. Here's the reason I'm an Uber shareholder. My Uber costs are going up. At least I want to hedge that by being an Uber shareholder, saying I'm keeping it's a very small consolation price. But I do think, and I've noticed this already, and you probably noticed as well, your Uber charges there used to be a time when Uber was just not just discounted, they were just giving away the service. Growth was everything, right? That's no longer the case. You can start to see these models kind of converge. And we'll see how it plays out. The big disruption here could be automated driving. And that's a different game. And in my story, I think if it happens, Tesla is not going to want to run a ride-sharing business, a nasty logistics business. Uber is probably going to be the platform through which Teslas might do their automated driving. I could be wrong on all of these components. Right? And at the price I bought, I felt that I had enough going in my favor. So enough has happened that's good for me on Uber, but that doesn't mean I like the way the company was structured and grew. So in the case of Airbnb, which was my example for revenue growth, their operating margin was -10%. In fact, actually, it was actually -17 or 18% in the trailing 12 months. They were moving in the right direction. And my steady state margin, I gave them a 25% margin. As opposed to what? Remember when I showed you the revenues for Airbnb, I showed you the hotel business revenues? The typical margin for hotel companies is like 12 to 15% operating margins. That's a good hotel company. I'm giving Airbnb 25% margins. Why? Because it's not a hotel company, it's an intermediary. And here I had an advantage that I did not have with Uber. There are established companies out there that have been doing this for a lot longer than Airbnb. I'm sure you've used both. Yesterday, there was somebody in my office who used to work at Expedia in 2001. Expedia is ancient by tech company standards, but that's what the Expedia business model is, right? They used to use hotels as opposed to apartments. So I looked at Expedia and Booking.com to get a sense of what do margins look like in the intermediary business. And I got two very divergent answers. With Booking.com, I got about 35%. So I'm going to focus on 2019 because the last 12 months included the COVID months. And for Expedia, I got 8%. That's kind of puzzling that Expedia's margins are so much lower than Booking.com because you get on the websites, they look pretty much the same, right? You pick a destination. And so I started digging, and it turns out that Expedia has a second component to their business model where they buy entire sections of hotel rooms that they then own as inventory. And then when they rent those out, they keep the income from them. So in a sense, the hotels get prepaid. That keeps their margins down because that's a more, I'm not saying it's a better model or a worse model, it's a different model. So Booking.com seemed to be a more reasonable company to aspire for. Initially, I was thinking 35%. But then if Airbnb and Booking.com and Expedia and everybody's brother and sister is in there offering intermediaries, my guess is you're going to see the margins slide down. So in my story, at least, 25% becomes my end margin. Costs are going to come down, margins are going to come down. As I said, it's my story. You don't like my story, make it your own, right? Pick your margin, pick your story. And that's what you're trying to do with the target margin. Finally, let's turn to the third ingredient. You got revenue growth, you got margins. The third ingredient, how much do I need to reinvest to create this growth? Again, let's look at, you could look at history, right? You could look at the sales. So basically sales to invested capital. Remember how we computed return on invested capital? All we're doing is replacing after-tax operating income to revenues here. So I can say, what were the revenues? What's the invested capital? I can look at what that number looks like over time. So basically getting a measure, this business, how much will I need to invest this capital to grow? Now, capital intensive businesses, obviously this ratio is going to be much lower. Infrastructure companies, this ratio is often less than 1. You have so much invested capital revenue. You think of tech companies as being capital light, right? And that might be true for some tech companies, but you'd be surprised at how much reinvestment tech companies often have to make, or companies that are not manufactured to grow, because they grow through acquisition, they grow through R&D. And once you start capitalizing them and bringing them on, those sales to capital ratios can be low as well. So you're looking at history to get a sense of both what this company's history is and what the industry average is, so you can make a judgment. Of the three numbers, this is the number that always gives me the most trouble. It gives me the most trouble because while I can look at industry averages and company-specific numbers, here are the factors that can throw off your estimate. What is the scaling effect? As companies get bigger, will they need to reinvest less or more to get the same revenues? I don't know the answer. It depends on the business. If you're in retailing, as you scale up, your sales to capital ratio is probably going to be pretty stable because you open more stores. But if you're an online retailer, it might turn out that as you get larger, you can deliver the same revenues with less invested capital. Second, you're going to be looking at how much excess capacity you've already built in. And let's see why. Remember, the sales to invested capital basically is what you're investing to get revenue growth next year. But if you have excess capacity, you get a freebie, right? For year 1, 2, and 3, you might be able to grow with very little reinvestment. You're going to have $500 of revenues for every dollar of capital. Essentially, if you, when I valued Tesla in 2021, they just built the Shanghai plant. Nothing was being produced. But that Shanghai plant was going to cover their growth needs, at least significantly, for the next 3 years. You can look at excess capacity. And there's a third component in the model that initially I didn't give much leeway on, but now I will give you a way to adjust if you want. The easiest way to build the model is to take the change in revenues from year 1 to 2, divide. So let's say your sales to capital ratio is 2, and your revenues go from $1 billion to $2 billion from year 1 to 2. You take the change and divide by 2, you get the reinvestment that year. It's nice, it's easy. But there's an implicit assumption I'm making, which is my reinvestment delivers the revenues in the same year. If I grow through acquisitions, it's pretty reasonable because I buy the company, I get the revenue. But if I'm a company that has to build a factory, I build a factory, I probably am not going to get revenues in the year that I spend building the factory, maybe a year or two later. For technology companies, we said, or pharmaceutical companies, your big reinvestment is in R&D. You invest $1 billion in R&D. You'd be lucky to get revenues, what, year 5, year 6, year 7? There can be a lagged effect. So if you look at the spreadsheet that I sent you, I let you set a lag up to 3 years. Beyond that, it became nightmarish to do the math and put it into the spreadsheet. So if you say it takes 3 years, here's what I will do. I'll take the change in revenues from year 4 to 5, divide it by 2, and put it in year 1. So if you see that happening, I'm trying to reflect the fact that you have to wait to see reinvestment pay. So sales to capital ratios basically capture how much you're reinvesting. The higher the number, the more efficiently you're reinvesting. So let me complete the Airbnb story. There's my revenues growing based on the story I told you, that being in a big market, becoming a dominant player. There's the operating margin going from minus 13.69% to plus 25%. For the reinvestment, I looked at their history. I looked at Booking.com, Expedia.com, all around $2 of revenue for $1 of capital. What's the invested capital in? Computer platforms, basically acquisitions, things that might not show up as traditional CapEx, but are still reinvestment. I kept the sales to capital ratio at 2. I didn't see any evidence of scaling benefits here. If I saw evidence of scaling benefits, that number would have increased over time. And take the change in sales each year, divide by 2, I get the reinvestment each year. Reinvestment includes everything: net CapEx, change in working capital, acquisitions, R&D, it's all in there. I'm just consolidating it. And the reason I'm consolidating it is, for a company like Airbnb, I have no idea what they will be reinvesting in, but I do know they need to spend money. And it's not just me. I'll wager that Airbnb's management in 2020 had no idea what they'd be reinvesting in, because you're basically in a business where you're still trying to find your feet. But here's the bottom line. You take the after-tax operating income, you subtract out the reinvestment, you come up with free cash for the firm. I'm telling a pretty uplifting story about Airbnb, right? A company that's going to dominate the hospitality business, see margins improve towards 25%. It's reinvesting like a typical company. And the reason I'm saying that, if you look at the free cash flow of the firm, you can notice that it's negative. 1, 2, 3, 4, 5, 6 years. You got to live through a lot of cash burn before you see cash flow positive. Could Airbnb turn cash flow positive sooner?
Yeah.
What do they need to do? Grow less. The bigger your ambitions, the more negative your cash flows are going to be. It's not because I'm pessimistic, but because I'm being realistic. So if you have big ambitions for your company, you're seeing it grow, don't be surprised to see negative free cash flow. It's a feature, not a bug, of what you've assumed. And don't try to fix it. Because fixing it means changing the company, changing the business model, changing the story. And this is what comes out of the story. One final thing is, I actually keep track of what I call an imputed return on capital. This is the bottom of the spreadsheet. And here's what I do. I keep track of your estimates of after-tax operating income based on your margin and your growth, and your reinvestment goes into, it's a delta in your invested capital. I keep track of your invested capital. The last column, I get an estimate of what kind of return on capital you will have as a company by the time you get to, this is my sanity check. 39% is a really high return on capital. I'm making Airbnb into a special company. But if I got 390%, there's a signal here I should be listening to from my spreadsheet saying, you're not reinvesting enough. If I get 3.9% in year 10, I'm reinvesting way too much. So there is a feedback loop that if you listen to, you can go to adjust your sales capital. One final point, and this is something I find that a lot of people miss. When we talk about growth coming from return on capital or using sales to capital, we're using what I call marginal numbers, what I will make on my new projects. The reason I emphasize that is, how do we compute return on capital for a company? We take total after-tax operating income, divide by total invested capital. That's an aggregated return on capital. Remember in Econ 101, you have this marginal return schedule? There's something similar to that happening. Can you have a company where the aggregated return on capital looks great and the marginal return on capital looks awful? Absolutely. Take a look at Google. Amazing return on capital, but where does it come from? The search box, which they invented, what, 20 years ago? They have so much fat coming out of that, they can subtract out the expenses of all the other bets and Gemini and still end up with a great looking return on capital. It'd be nice if we could observe the marginal return on capital, right? What they're making on their new projects. And there's a way, at least indirectly, you can do this. If you take the change in sales from year to year, and the change in invested capital from year to year, you can get a measure of marginal return. It's an incredibly noisy number, so be ready for a lot of noise. But if you track that over time, take a look at Google and track it over time, the marginal returns on capital look much, much lower than the aggregated returns on capital, kind of a signal of, hey, this company did some great things in the business that's in, but everything it's trying on top of it is not adding much. And that's what's driving your future growth and value. You got to get a lot more cautious about those forecasts. So that's the three big inputs. As you open the spreadsheet, rather than look just at the past or look for easy answers in industry averages, think about your company, think about its business model, think through. So give it a shot. Now, my suggestion is don't try to read up more and more and more on the company. That's going to be a temptation. There's so much out there. Open the spreadsheet, do a first draft, give it your best shot with what you know about the company now and what you think about the business model. And then go looking for information on things that you feel uncertain about. It'll give you focus when you search. Because otherwise you're going to get lost in Google search and you have no idea what you were looking for in the first place. And that's not a good place to be. Yes, Justin.
Why is it T-2?
Because if you're looking at a 1 year lag, that's what the 1 year lag, if there's no lag, then you would just use T minus one. So basically depending on the lag, right? Because return on capital, we compute with the lag always. So I'm trying to stay consistent with that notion. So let's talk about closure and valuation. I mean, the reason we need closure is because we have a math problem. The value of an asset is the present value of its expected cash flows in perpetuity, and we can't go on forever. So what do? At some point in time, we stop and we estimate a terminal value. That was the starting question today. And let's list out the four. And now I'm going to take the four choices you had and look at what that would look like in a valuation. If you decided that a liquidation value is how you're going to put closure in, what are you going to look at? You're going to look at the assets you have as a company, what assets you will have in year 10, and what you will get by selling those assets. In theory, that's what we should be doing. In practice, when people talk about liquidation value, guess what they use as a proxy for liquidation value? They use book value, right? Which is an incredibly dangerous place to go. So if that is your definition of liquidation value, at least be honest about the fact that you're letting accounting book value. And for companies like pharmaceutical companies and technology companies, it's going to bear no resemblance to them. But the reality is it's an asset-based way of thinking about the world. Where liquidation value is easiest to do is if you own a bunch of buildings and you say, look, how much will the buildings be worth in year 10? Anything else gets, layers of estimation. Second, you can value it as a going concern that will keep going in perpetuity. Whenever I make this, of course, we said, no, that's so unrealistic. You're right. No company lasts forever. But if it lasts 70, 80, 90 years, using a perpetuity gives you a number so close to what the number would be with a 70-year life that it's a convenience assumption. It's an assumption that was developed in the 20th century when typical successful companies lasted 80, 100, 125 years. So you're assuming a company will go forever. And because that growth rate is forever, it comes with caps. And we'll talk about the cap. The third approach is you say, look, I'm going to stop in year 10, but I don't want to assume my company will last forever. Why? Because it is a finite life company. It's a commodity, a mining company, and the resource runs out. Or it could be a technology company. The technology is going to evolve, and I know these technologies don't last. We talked about perpetual growth model coming out of the 20th century. If you look at the great companies of the 21st century, and you can put in whatever you want into the great column, it's going to be very dangerous to assume that a Facebook can last 125 years. Technology changes. What about a Zoom? It's a terrifying company to value. Why? Because it caught on in 2020, but if you think about what makes Zoom special, there's not that much sticky in the model, right? It's amazing that it's actually held on even for the years that it has, but using a perpetual growth on Zoom seems to be begging to be taken to the cleaners. So you can use a growing annuity model. And finally, of course, the one way you should not do it, even though it's easy, it's simple, it seems like a simple answer, is applying a pricing because it makes your intrinsic value into forward pricing. So let's talk about perpetual growth models. It comes from this equation. I remember the first time I saw this in a finance class, and I said, this is so neat. You have a cash flow that lasts forever. I don't have to estimate cash flows every year. You take the cash flow and divide by R minus G, the discount rate, you get the present value. Now, I think I might have mentioned this. This is not a finance equation. Mathematicians, this is it's just value of an infinite series, right? If your growth is constant, your discount rate is constant, you write that series out. 200 years ago, mathematicians wrote the value of that infinite series. We stole it. We made it part of. It's incredibly powerful because it captures cash flows in perpetuity. But that growth is a growth rate forever. So I'm going to state something that shouldn't have to be said, but I'm going to say anyway. That growth rate for a company cannot exceed the growth rate of the economy in which it operates. You can make it global, you can make it domestic, but once you tell me where it operates, it cannot exceed the growth. You see why, right? If you don't believe me, take two numbers on your Excel spreadsheet. Make the first number a really big number and the second number a really small number. Then let the really small number grow at 5% a year. And really let the really big number grow at 3% a year. Keep going on your spreadsheet. There will be a point, this is guaranteed, where the small number is going to grow past the big number. Or in context of valuation, if you let a company grow at a rate faster than the economy, it will become the economy. Then what? There are some assumptions in valuation where you and I can agree to disagree. So if you tell me the revenue growth for Airbnb is 60%, and I say it's going to be 30% for the next 10 years, that's a disagreement. Maybe you have a bigger story. Maybe you see Airbnb doing things, but this is not an assumption where you're at war with me. You're at war with math. And when you're at war with math, math always wins. So you're capped at the growth rate of the economy. But let's dig a little deeper. That's kind of a standard rule. So let's say the economy is growing at 4% a year. Can I use 4% for every company that I value as my perpetual growth? Here's the danger of doing that. If every mature company grows at the growth rate of the economy, where do growth companies go in this economy? Do you see what I mean? In fact, mature companies, almost by definition, collectively have to grow at a rate less than the economy. And in economies like the US, where you have a large segment of growth companies popping up, they could be well below the growth rate of the economy. So you got a cap, but it's not your floor. Your growth rate can be less than. Can it be negative? Of course. What kinds of companies would use a negative growth rate in?
Ones with the declining asset base.
Or a revenue model where you see an end in sight where, so do you have an example of a company we might use a negative growth rate? Brick and mortar retail, you can argue the end game is here, right? Who thinks about Bed Bath & Beyond? Say, I see great things happening, right? Taxi cab companies in 2000, the medallion values collapsed. Tobacco companies. Fossil fuel companies, this is a big debate, right? And this is the big debate on climate change. Are fossil fuel companies being priced as if they're declining companies? And in 2011 through 15, they were. But the market seems to have shifted on that and gone back to treating them as growth assets, suggesting the failure of impact investing to change the underlying story. Growth rates can be negative. Should they be nominal? Yeah, go ahead.
But what if in the valuation implicitly you suggest that this, for example, a fossil fuel will invest
Or Philip Morris will buy vaping
or,
companies,
yeah,
right? I
the
mean,
management will be
you
one
could, in
of
which
those
case
things,
the question you can then ask is they will continue to grow, but is that growth value adding or value destroying? What has ExxonMobil said so far about the green energy investments?
that right now it's value destroying, but
They're not even saying right now. They say we don't see light at the end of the tunnel in this business. We're competing against companies that are so heavily subsidized, they don't care what they're doing. We can't afford to do it. In a sense, we've ruined the green energy business with the way we've invested in green energy, right? We made it impossible for any business model, money-making company to compete in this space, because how do you compete against insane people who don't care what they charge as price? Because they're going to get subsidized anyway. So I think you can bring that into a declining business story by saying, and in fact, if you remember, Philip Morris tried this with Juul.
Yeah.
Didn't end well.
Yeah.
But that was their objective. You can go back to being a growth company if you find something else that is addictive that doesn't look like cigarettes. Yes, David. The green energy. I will leave that there because in a sense, I think I'll tell you why I pick on green energy. The last couple of weeks ago, I was teaching the Triumph MBA program. 50 people in the class, 10 were fossil fuel. And so these are people in their 30s and 40s working in companies. 10 work at big fossil fuel companies. And I usually pick a company for them because it's a 2-day course. They can't go to Bloomberg. and I pick a company trying to pick the part of the world they're in and the business they're in. So I wanted to kind of give every fossil fuel company person a green energy company. And this is corporate finance. So I needed a company where you're at least making some money and looking at some, you know what? I could not find a single healthy green energy company in the world, not one. Okay. 10 years ago, you could say they're still young, but I mean, you take Vestas, right? It's been around forever. You take these companies that have been around 20, 25, 30 years. There's something systemic that is creating this problem. Yeah. And I think that we can, it's a topic for a different forum because it goes to the heart of why impact investing is not having the impact it was designed to make. So if in your story, you see a declining business company, a tobacco company saying, look, we're an addiction company. That's our strong point is we know how to be viewed as evil and still continue to function. Remember, tobacco companies have had to do this for 30 years. They said, we don't care. You think of us as evil. We sell a product. People need it. It's addictive. Maybe they can find other products like it, and I won't name them. But if cannabis becomes legal, Altria is in a far better position to make that a money-making viable business than any cannabis company out there. They know how to do this right, if you can define doing right as adding more addictive substances to society. Now,
It's interesting you bring up cannabis because from Canada, where like it's
25, but
yeah, it's
again,
illegal for like 6 years, but the government has just like so horrendously, wrecked the market through the regulations.
I'll tell you, I live in San Diego. If I take my dog for a walk, we both come back high. Right? I mean, it's the smoke just wafts through, right? Everybody smoke, but cannabis stores don't make much money. Why? Because legal cannabis is so much more expensive. So they're still buying from the joint dealer on the corner, right? They're doing it openly now and blowing smoke in my face. That's the only difference. But I think the basic problem is legal cannabis because of so what you have is two sets of rules. One for legal cannabis companies, they have to follow all the regulations and rules. And the joint dealer in the corner who couldn't care less about what those rules are is selling at a much lower cost. So we could do a class on cannabis company. I had a post on cannabis company valuation, and I did it right after a walk with my dog, and we were both high. So I have no idea what I actually wrote. But I think it's actually an interesting question of how do these businesses, eventually it might become, especially in the US legalizes cannabis across all 50 states. It's a question of when, not a question of whether. It is going to happen, right? The question is, how will this business evolve? Because in the US, running a cannabis company is a nightmare. You cross borders, you broken laws, no bank will lend to you because of the fact that nationally you don't have this. So it's an interesting question, but let's face it, you need a company in this space that knows how to deal with the kind of bad stuff that's going to come with cannabis, right? There is going to be stuff that comes with it. And I think that's why the old tobacco companies are well positioned in that sense, because they've had to deal with this regulation and restrictions and laws and taxes specifically directed to them, still come out on the other hand making money. Yes.
Question in my head, the company that I'm valuing, like
Yeah.
a media company.
But put a name for the company. Let's not leave it.
Okay, it's the New York.
Oh, you haven't picked a media
Yeah,
company. Okay.
Yes.
Oh, the New
So
York.
I suppose I think it's gonna be.
Fascinating company, right? Because it's one of the few old-time publication companies that's not just still around, is prospering. I mean, you can contrast the New York Times with the Washington Post. Say, what did the Times do? And what did the Times do, you think, that given them a pathway at least to live and prosper in this space?
I think they did a really good well on digitalizing.
And what is it about digital? Everybody's an online site. So what is it specific? You know what segments of the New York Times online site make it sticky? The games and the cooking. They latched on to the fact that if you have the New York Times cooking app and you save stuff in it and you stop your subscription, there goes your recipe book, right? It's stickiness. I think that whoever designed that should be given an incredible boost in pay because they found that they're not coming to read the news. So in my view, at some point in time, you go to the New York Times offices, there'll be 11 floors for cooking, 7 floors for games, And maybe in the basement, they'll put all the journalists, say, do what you do, but we don't care much about you. You're not the ones delivering the subscription models, but it's a fascinating case of stickiness. What do you do as a company? So I think in a sense, they're like Costco in the retail space. New York Times is a good example of how a status quo, an older company can devise this place for itself. Now, it's still an advertising-driven company. It'll never be a Google or a Facebook, but there's a niche portion, a targeted market you go after if you advertise in the New York Times. So I think it should be a fun company to value from that perspective. Yeah. But it's going to increasingly become a subscription-driven company. That's basically what it is. Yeah. So let's talk about, one more thing about the growth rate. If you can do your entire valuation in real terms, which almost nobody does in the US, maybe in Latin America, in which case your cap on your growth rate is a real growth rate, but most of us do things in nominal terms. If you do things in nominal terms, the cap on your growth is a nominal growth rate. Right? If you do it in dollar terms, it's a dollar nominal. You see why currency matters, right? If you do your valuation in Turkish lira, you can have a growth rate in perpetuity of 12% a year. It sounds astonishingly high, but the inflation isn't. So let's talk about the growth. And I'm going to give you what I use as my cap on the growth. It's built into the spreadsheet as a default. You can override it if you want. But I use the risk-free rate as my proxy for the nominal growth rate of the economy. I get pushed on this all the time. I'll give you my justification. It's twofold. One is almost theoretical. The other is very pragmatic. Here's the theoretical reason. Now, when we talked about risk-free rates, remember we talked about the two components, expected inflation and expected real interest rates, the Fisher equation. So let's write that out for the risk-free rate. What goes in a nominal growth rate in an economy? Expected inflation and expected real growth. So we set those equations next to each other. The expected inflation is in both equations. You can cancel them out. The question is, what is the link between expected real interest rates and expected real growth rates? I don't know whether you remember your Econ 101 class. I remember my Econ 101 class when we talked about real interest rates. And I remember the professor talking about apples. You borrow 100 apples today, you got to return 102 apples. Why are we talking about apples? Because when you talk in real terms, you're talking almost in terms of goods and services. You borrow 100 units, you return 102 units. You see where this is going, right? If I promise a real interest rate of 2%, my economy has to be growing at least 2% to be able to deliver that 2%. So real interest rates and real growth rates in the long term, not necessarily in the short term, have to be linked to each other. Not maybe exactly equal, but if you have high real growth, you'll have high real interest rates. And low real growth, low real interest rates. In the short term, of course, you can get central banks altering the real rates, but that's the long term. I think the nominal risk-free rate is the best forecast of the nominal growth rate of the economy. That's a statement that we can empirically test, right? So I decided to test it. So here's what I did. I went back, I can update this to 2023, but I went back, from 1954 through 2021, collected the T-bond rate every year, and then looked at the inflation rate and real GDP growth to see if they're linked up. How good a predictor of no? So if you look at each decade and look at the T-bond rate during the decade and the growth rate during the decade, between 1954 and 80, the growth rate ran ahead of the T-bond rate. Between 81 and 2008, the growth rate lagged the risk-free rate. What does that tell you? It tells you about an economy starting to mature, to slow down. 1954, 55, 60, 65, maybe even up to 70. The US was a growth machine. It grew at high real growth rates. In the long term, the numbers converge. So if you ask me, why do I use the risk-free rate as a growth rate? Here's your choice. If you don't use the risk-free rate as your proxy for nominal growth rate in the economy, what do you use instead? You ask macroeconomists what they think. Do you trust macroeconomists anymore? These guys are almost as good as soothsayers, right? They have a tough enough time telling you what the nominal growth rate was last year. Forget about the next 10 years. I would rather take the risk-free rate as my proxy than take some macroeconomic forecast of nominal growth in the economy. So that's my theory reason. Let me give you the very pragmatic reason why, even if you don't believe anything that I've said about the risk-free rate being a good proxy for the growth rate, it's still a good idea to link the two. It preserves internal consistency in your valuation. Remember we talked about risk-free rates, we talked about currencies with negative risk-free rates or very low risk-free rates in the US 3 years ago. Now, by itself, if you look at really low or negative risk-free rates, you worry about discount rates becoming too low. And from a valuation perspective, valuations becoming too high, right? That's why people were terrified of negative risk-free rate. If you connect the risk-free rate to your growth rate in perpetuity, you got a self-correcting mechanism. If risk-free rates are too low, and that's what you're telling me, my growth rates is also going to be too low. If you think risk-free rates are too high, my growth rates is all, in effect, I'm canceling out whatever effects there are of rates being much lower or higher than expected. You might not believe me, so I'm going to take an actual example. In September 2019, I was valuing Heineken. Heineken is a multinational brewery based in Europe. And I was doing my valuation in euros. It's a Dutch company. My risk-free rate in euros was minus 0.5%. I was doing this in front of a European audience, and there were 7 people from the Heineken finance group in the audience because they struggle with this on a daily basis. They were normalizing risk-free rates because they said, we can't live with negative risk-free rates, nothing will work. So I said, okay, let's see what happens to your value. So when I said I'm going to use a minus 0.5% risk-free rate, I didn't show them the rest of the value. I said, what do you think I'm going to find for Heineken? They said, you're probably going to find us massively undervalued because you're going to give us a really low cost of capital. Now, part of that statement is true. I did give them a really low cost of capital because we start with a negative risk-free rate and build up. You're going to end up with a lower number at the end with the risk premium, beta, even all those factors, 5% cost of capital. That's the good news. But here's the bad news. When I projected my growth, remember, your numerator doesn't live in a different world from your denominator. If your denominator is a negative risk-free rate base, that's telling you something about the future for your economy, right? It's telling you that there's deflation coming, at least markets are building it in, and that real growth is not going to be great. So when I projected out the growth for the next 5 years, I was pretty, my growth rates were depressed by the feeling. But here was the absolute top of the pyramid, where the 7 people, Heineken in particular, freaked out. I said, I get to year 10, I'm going to make you a mature company, and I'm going to give you a minus 0.5% growth rate forever. I said, no, you can't do that. That's so unfair. I said, you weren't complaining when I gave you a really low cost of capital with a negative risk-free rate. What one hand gives you, the other hand takes away. My end valuation for Heineken was 60 euros per share, well below the. Now, I'm not saying that's coming from my risk rate. It's coming from the fact that I don't like the company that much. But what you get when you link the risk-free rate to the growth rate is you take one huge weight off your shoulders. You'd be amazed at how much time people spend trying to estimate the growth rate in perpetuity after year 10. What's wrong with you? You're in 2024, you're telling me that you're trying to estimate the growth rate from 2030. Do you even know whether there's going to be a 2034? Let's talk about existential questions. It's not the place you want to spend your energy. Link it to the risk rate. So in the spreadsheet, the default is I move your growth rate to the risk-free rate in perpetuity. But I also let you change it. When would you change it? If you have a tobacco company, you can set the growth rate at below the risk-free rate, you can make it negative. If you truly want to risk walking towards a hangman, you can set the growth rate above. I don't stop you. I give you enough rope to hang yourself if that's what you choose to do. There'll be a little warning saying you're exceeding the risk-free rate. Do you really, really, really want to do this? And if you say yes, I'll let you go. But this is how valuations essentially run off the tracks, is when you violate those caps. Yes, I said.
Are there a lot of companies that link it to inflation? Like I grow at the pace of inflation.
You could. We'll talk about that, right? Because people assume that if you grow at inflation, what is the bonus you get? I don't need to build extra capacity, so I don't need reinvestment. We'll talk about the flaw in that leads people to assume no net capex, no change in working capital. But there are companies that use the inflation rate, which is obviously less than the risk-free rate. So so it's a subset of it. It doesn't violate my risk-free rate. Now, when you get to your terminal year and you give my company a growth rate, you can't forget all the things we talked about in the context of growth. Remember, we have to reinvest to grow. And if you remember what drives the growth rate for a company with stable margins, it's reinvestment rate times return on capital. If I play with the algebra a little bit, And by definition, if your company is mature, the margins better not be changing. Your reinvestment rate in stable growth can be written as your stable growth rate divided by the stable return on capital. So if you want to grow 3% with a 15% return on capital, you have to reinvest 20%. I've locked you in. I've essentially brought in the dark side of growth, right? So the good side is in the denominator, use a higher growth rate. Now I'm saying, but I've got to adjust your after-tax operating income. And it's easy to see the consequences. If you have a company that basically has a cost of capital of 10%, I've computed the terminal value for this company as a function of its growth rate going from 0% to 3%. When my return on capital is 10%, changing my growth rate has no effect on value. Why? Because I'm earning exactly, it's like taking zero net present value projects over and over again. If I earn more than my cost of capital, and what kinds of companies would that be the case in? Maybe you have a company with incredible sustainable advantages. Its growth drops to stable growth in year 10, but its competitive advantages last on. You're valuing Coca-Cola, the brand name's not going to go away after year 10. For the Mag 7 stocks that I valued a couple of weeks ago, every single one of them, I left the return on capital above the cost of capital, because even if their growth slackens, they still have competitive advantages that essentially give them a lead time. Because they're increasing my growth rate will increase my terminal value. But I'm going to give you a kind of perverse case. Is it possible to have a company where you get to stable growth, they're going to grow at 2% a year, but they do so by investing at less than their cost of capital? What kind of company would it have to be? Of course, it's in a bad business now, it's earning less, but this is worse, right? Not only is it in a bad business, it's growing a bad business. What is the connective tissue in a story that will allow you to let that continue? It's like the definition of insanity, right? You keep throwing more good money into bad business. When managers do that, what can stop them? What do you hope?
Competitors get killed.
Competitors will, I mean, they will actually want you to keep doing this because they want you to die, throw money into a bad business, right? What's Nelson Peltz's argument against Disney that they're throwing good money into bad, whether that's true or not? So one thing that stops them is activist investors, hostile acquisitions, corporate governance in its broadest sense is about creating change in companies where managers are doing insane things. So if you have a company with strong corporate governance, say something is going to happen by year 10. Somebody will show up. I don't see them on the horizon now, but this is too insane. Something's going to stop them. But you could have invested in Viacom 25 years ago, and they were doing some insane things along the way. But there was nothing you could have done. Why? Because the Redstones controlled the company. You're valuing a family group company in Asia that's badly managed and badly run. They earn a 5% return, but they keep growing. And you're valuing the company. You're saying nobody's going to be able to. So when you tell your story about a company, there's got to be a corporate governance component there that explains why your company will continue to earn less than the cost of capital. So when you think about that return on capital in perpetuity, which is an input into the model, again, the default in the model is I'll push your return on capital to the cost of capital. But if you don't like that default, think through what about your company will make it different. Now, when I wrote my first book on valuation, it was 1988. John Wiley published it. And they published in the same year a book by McKinsey on valuation. So our books have kind of coexisted under the same publisher for about almost 30 years. And I get questions from people reading the McKinsey book about things that the McKinsey people do. The book used to be written by Tim Kohler and Tom Copeland. Now it's written by committee. Groups of people write different chapters. So you get to the terminal value chapter. In the McKinsey book, the terminal value is NOPAT, which is their version of after-tax operating income. It's net operating profits after taxes divided by the cost of capital. That's it. There's no growth in there. And I get questions like, how come there's no growth in the model? To which my response is, why don't you write to McKinsey? Why are you writing to me? They must think we all hang out together in a room every day and talk valuation all day. I have no desire to hang out with McKinsey people and talk valuation all day. But there's a reason it's in the chapter. McKinsey assumes, not just as a default, as a blanket statement, that if a company is a mature company, its return on capital is equal to its cost of capital. They give an economic rationale. No competitive advantage lasts forever, which is absolutely true, but they assume it happens in year 10. If you assume that what happens, growth doesn't matter, right? If growth doesn't matter, what's the easiest growth rate to work with? 0. Might as well forget about the reinvestment, just put in a 0 growth rate. And then so when I responded, I said, that's what they're assuming. And then I said, by the way, their own research suggests that maybe they're not on solid ground. Do you guys, have you ever read the McKinsey Quarterly? It's actually, go to the McKinsey site and register. It's free. You can basically, will get so everything, McKinsey basically has consultants doing research in the general sense, using McKinsey's proprietary database. A lot of it is fluff with buzzwords, but some of it is actually very interesting because they have a proprietary database that none of us has access to. So one of the studies they looked at is what happens to companies as they age. So they were able to track this database of companies they've tracked for 60, 70, 80 years. And there are 2 things they discovered. The first was not surprising. As companies age, their growth rate drops towards the growth rate of the economy, which is what we assume in terminal value. But the second finding that they found was that while growth rates drop off towards the growth rate of the economy, returns on capital actually stay pretty stable even as companies become 50, 60, 70 years old. Of course, there's a survivor bias in the companies they're focused on. What does that tell me? When I get to year 10, I'm not going to be in a hurry to do what McKinsey does as a bank and assume every company earns its cost of capital. It's got to be a question that is specific to your company. What kind of competitive advantages does it have? Will they last for a really long time? And the answer is yes. This is the place to show it, is with the return on capital in your terminal value. Let's get to Isaac's point, because I'm going to point to something that I see in terminal value calculations, in discounted cash flow valuations, that I think is valuation malpractice. Here's how it'll go. You get to year 10, you tell me your company is a mature company. And then I think this is almost hard-coded into the spreadsheet. If you're a mature company, you grow at the inflation rate. What does that mean? You're not selling more units, you're just raising the price with inflation rate. CapEx offsets depreciation. Well, you don't need any excess new capacity, right? And working capital won't really change because it's just inflation. So you have no change in working capital, it's 0. Net CapEx offsets depreciation, net CapEx is 0. 0 plus 0 is 0. I think 0 divided by any number is 0, so your reinvestment rate is 0. But they have a 2% growth rate. Sounds alluring, right? If I'm growing at the inflation rate, why would I need to reinvest? Now, what is net CapEx? You know, if in a mature company, what is that net CapEx? What is the CapEx going into? Capital maintenance. You're replacing old capital assets with new capital assets, right? I mean, just a couple of weeks ago, I was in Disneyland. 20% of the rides are shut down. See, that's terrible. Now, the Splash Mountain is now, it's got walls around it because it's going to become Tiana's something, but it's going to take about 2 or 3 years of major investment. And this is routine, right? If you go through, you're replacing old equipment with new equipment. Okay. Will it cost you exactly the same amount as the old equipment? You live in a world with inflation that you counted on for your revenues to grow. The same inflation can't magically disappear when you talk about replacing or renewing equipment. So if inflation is helping you in the numerator, guess what? You still have a reinvestment, not because you're increasing capacity, but maintaining capacity will cost you more than the original capacity cost you 10 years ago.
But maintenance is different than like replacing is different than maintaining. Maintaining could go in OpEx and grow at the same percent of inflation.
But where are you showing it in your cash flows?
You like in the OpEx, like in
no, you can't. What Disney spends on Splash Mountain doesn't go into operating expenses.
That's replacing. That's not maintaining. That's like a major.
We're playing with words, right? Capital maintenance, at least in valuation, is not maintenance expenditure. It's replacing old capital expenditure. That's what maintenance CapEx and evaluation is. It's never maintenance expense. That's operating expense. This is just replacing long-term assets with newer versions because they've run out of time.
Like if you think of a building,
yeah,
and you always put in the amount of money you need to keep it
That's a part of it is, but you don't think do you know how much maintenance CapEx has gone into this building? It's mind boggling. It doesn't look like it has, right? But the amount, for instance, if you have to replace one of the elevators, which sooner or later you have to, you're going to get stuck on one of those sooner or later. It is a capital expenditure. I don't care where you put it in your income statement, and for a nonprofit, it might not matter. So that's what we're talking about here when we talk about net CapEx. If it's being misaccounted, move it like we did R&D into the CapEx. But if there is inflation, there will be reinvestment to maintain your asset base. You know how we know that that's true? Is if this is true, that once a company becomes mature, that it doesn't need reinvestment, it can keep growing. What should happen to the return on capital of really old companies? What should happen to the return on capital at really old companies? No, if your growth, if you're operating, it'll go to infinity, right? So if I classify companies on age, the return on capital, the oldest company should be 800%. You don't see that. You break it down. So clearly the assumption is at odds with the reality there. So even if you grow at the inflation rate, there will be reinvestment. So that's a sleight of hand. And there's one final point. You get to year 10, you make your company a mature company. That's bad news, right, for the company. You lower the growth rate to 2 or 3%. Give it the good stuff that comes with being a mature company. What's the good stuff? You might have started your valuation with a beta 1.8 and no debt ratio. Why? Because it's a risky company, it can't afford to borrow money. You get to year 10, what are you telling me about a company? Mature, money-making company. It's almost incompatible to tell me a company is mature and keep its beta at 1.8. And if the company is truly mature and throwing off earnings and cash flows, it should be able to, it might choose not to borrow money, but clearly has debt capacity. Do you see where I'm going? The cost of capital for your company in year 10 cannot be the same as your cost of capital starting off. If it's a growing company, it should move towards. So again, in the spreadsheet, my default is I move it towards the average cost of capital of a company in the market. And I let you play with it. If you're a really risky business, maybe you'll set a little above, really safe business, a little below, but you don't have much room to run. Right? The divergence in cost of capital of mature companies is going to be much lower than the divergence across all companies. Returns on capital right now might be insanely high if you're in a niche business, but you scale up, almost by definition, your returns on capital are going to come. Doesn't have to go to the cost of capital, but the cost of capital is going to act like a magnet, pulling you towards it. And finally, your reinvestment always has to come from your assumptions about growth. It can't be hard-coded. So when you do your terminal value, never hard-code a reinvestment number, always link it to your growth rate. That way, if you change your mind and change your growth rate, the reinvestment changes with it. So that's a terminal value part. Any questions on that? So, I've tried to put guardrails into the spreadsheet with the defaults, but I trust you enough to remove the guardrails for your company if you feel the guardrails are too rigid. But that's part of the reason I want the valuation you're going to turn in at the end of the month. If you violate the guardrails, that's one of the comments I will send you, is you put in a 6% growth rate forever with US dollars. That's not an assumption problem. That's a math problem. You need to fix it. So hopefully those are not the kinds of things I have to give feedback on. But that's one of the things I check to see whether you're using the flexibility in the model to kind of go over the edge. Last step in this process, let's think about where we are, right? You think about the start of the process, we talked about choosing a cash flow to discount. They can be either to equity or to the firm. We talked about a discount rate to pick, but ultimately in every discounted model, cash flow model, you're trying to pick a cash flow, pick a discount rate that goes with that cash flow, and then build a model that kind of reflects your growth pattern. You're a mature company already. So at least I'll give you some guidance on if you wanted to design a DCF model that is customized to a company, what would it look like? So let's come to the first fork in the road. Should I do an equity valuation where I take cash flows to equity and discount the cost of equity? Or should I value the firm? My default, what do you think, Manish?
Shouldn't matter.
Well, would you want to do less work or more work? So basically the choice, you think that equity is less work? So let's see what you need for equity. You need free cash flows to equity, right? Free cash flows to equity require net income, reinvestment, net capex, change in working capital, and debt issuances and debt repayments, which if leverage is stable is easy, right? You just dispense with it. But if leverage is changing, it's a nightmare. So if leverage is changing, firm valuation is obviously much, much, much easier. And for most of your companies, you should start with the presumption that leverage might change 9 times out of 10. Firm. But if you have a company that's been around 80 years, its debt ratio is kind of locked in, then they're both equally easy. Then you can say it doesn't matter, I'll go there. But most of the time, this question that's going to drive this is what's happening to leverage. There will be firms where cases where you should only value the firm. In an LBO, for instance, where you're acquiring a firm, you're interested in not valuing the equity, it's to value the entire firm because you're acquiring the entire business. So this first choice, firm or equity, most of the time, my default is to go with firm valuation. I will give you a free cash flow equity model if you want to go down that road, but make sure you meet all those parameters. Leverage stable, then both models are equally easy to use. If you go the equity valuation route, you come to a second fork in the road. Should I discount dividends, maybe augment them with buybacks, or should I compute my free cash flow equity? Here, the easy way out is to discount dividends, right? And that's going to be okay if your company pays out roughly what it can in dividends. But the only way to check that is actually compute the free cash flow equity. And if you've done that, then why go to dividends in the first place? The second place you end up with the dividend discount model is when you try to compute free cash flow equity and you give up. So why would I give up? What do I need for free cash flow equity? I need net income, right? That's every company reports. I need net capex. I need change in working capital. I need debt issuances and debt repayments. I have a challenge for you. Pick up any bank and try to compute the free cash flow equity. You will drive yourself crazy. You get the net income. What's net capex for a bank? What's change in working capital? It's everything or nothing, right? Debt issuances and debt repayment. You don't even want to open that door because you're afraid of what you'll see behind it. So for much of the last century, analysts who came to this fork in the road would look at banks and say, I don't even know what the free cash flow equity is. I'm just going to use dividends. It's desperation. You can use it on. So the question of dividends versus free, if you can estimate the free cash flow equity for your company, use it. And even for banks, I'm going to give you a way of estimating free cash flow equity because I don't trust banks to pay out what they can afford to anymore. The dividend discount model becomes dangerous when that is the case. So you made a choice, cash flow equity or cash flow to the firm. This choice gets made for you, right? If you decide to go with cash flows to equity, your discount rate has to be a cost of equity. If you decide to do cash flow to the firm, your discount rate has to be a cost of capital. What currency should I use? Just pick one, stay consistent. What if I pick a high inflation currency like the Turkish lira? I'm going to get a high risk-free rate, a high growth rate, and I'm also going to get, a net effect that reflects inflation feeding into both my cash flows and my discount rates. Just be consistent. And should I use real and nominal? I'll give you my gut is if I can do it, I prefer to do everything in nominal terms because we live in a world where everything is nominal. Going into your local restaurant and saying, look, I'd like to pay in real terms. This nominal thing is getting a little bit out of control. This burrito used to be $12 last year. It's now $14.50. I live in a real world. They'll say, you're not really living in a real world. You've got a made up real, but we don't, our taxes on April 15th, I'd love to inflation adjust my income and tell the IRS, you know what, looks like I made more money, but it's not really true. The 6% inflation rate, it doesn't work. Our taxes are based on nominal numbers. Okay? So if you don't have to do it, you should. But if you decide for whatever reason that inflation is becoming such a big distraction that you want to focus on the business, do things in real terms, that's perfectly okay. But do it only in very high inflation scenarios where it's really messing up. And finally, when you look at your company, you're going to see, a couple of possibilities. One is your company is already a mature company. When would that be? Remember, we talked about revenue growth. You have a large market share company in a mature market. Company like Target, where's the high growth going to come from, right? You're one of the largest brick and mortar retail company in a business where brick and mortar retailing is losing market share to online retailing. You'll probably argue Target is already mature. You're valuing Volkswagen. Now, the dream of electric cars has kind of faded. The largest market share company of a traditional automobile business. If your company is already a mature company, you know what? You can use a stable growth model right now. To value a company, you need just 3 inputs. You see, Let me go back and change my company and pick a company with three. Because all you need is next year's cash flows, cost of capital and growth rate, and you're done. Your company might be a big company, but there's a little bit of growth left. Why? Because you take Levi Strauss, right? Mature company. You're saying everybody who wants jeans already has them. The part of the world that Levi Strauss has not grown in yet much is Asia. Maybe Asians will never want to wear jeans as much as the rest of the world, but maybe they do, and you've just not exploited it. You might have 5 years of growth where you get the growth, and then you're. So these are the two-stage models where you essentially give growth for a short period, and then you bring the growth rate down to stable growth. But every other case, you got this extended period of growth changing over time before you get, and I would include the youngest, highest growth companies there. I gave you only one spreadsheet, right? The FCFF simple grade. That spreadsheet is flexible enough that if you want to value a mature company, all you need to do is enter a growth rate that's equal to your stable growth rate as a growth rate for the next 10 years. Leave the margins unchanged over time and make the sales to capital ratio, today's sales to capital ratio, it'll become a stable growth model. You want a two-stage model? Not a problem. You basically enter the growth rate you want for the high growth phase, and then say beyond that, my growth rate becomes my stable growth rate. So you can make just the first 5 years. You want to make it a full-fledged growth model, then you can play with every lever. So when I built this spreadsheet, because I used to have 3 separate spreadsheets, a stable growth model, a two-stage model, it was getting incredibly messy and complex because you had to recreate each spreadsheet from scratch. You change your mind, you have to switch spreadsheets. So use the flexibility in the spreadsheet no matter what your pattern is. I'm always, people, when they, I get calls from people say, we've developed a really new discounted cash flow model. They'll give it a name, they'll actually patent it. Bernstein, well-known investor, claim to have, they patented a two-stage dividend discount model. So what exactly did you patent? Did you invent dividends? Did you invent the two-stage? Did you invent the model? People claim to have done new and different. There's nothing new or complex about discounted cash flow models. The reason you have hundreds of DCF models is they're like Lego boxes, right? You got a box of cash flow Legos, you got a box of discount rate Legos, and a box of, you connect the 3, you can create any kind of discounted cash flow model. The only thing is don't put the wrong pieces together, an equity piece with a firm piece. But every discounted cash flow model out there is some subset of choices made on cash flows, discount rate, and growth patterns. Any questions on DCF model? So at this point, you have all of the ammunition you need to value your company. And as I said, get started, because that is actually the biggest mountain to climb, because you keep putting it off. You think it's a lot more scary than it is. Once you get into the spreadsheet, it forces you to make choices. And in the process, you at least get an opening of what do I need to learn more about? Maybe it's about growth, maybe it's about margins, maybe it's about reinvestment. Because if you can make those choices, it's your story. And then, in a sense, think about the story that embeds these numbers. Next session, when we start, I'm going to talk about the loose ends, the things you have to do when you think you're done. Okay? We'll talk about the loose ends, starting with, I'll at least set it up, starting with cash and marketable securities. What do we do right now? We value the company, we take the cash balance, we add it on. I'm going to start with what I think is a provocative question. Are there companies where you value the company, you see 100 million in cash, where instead of adding the 100 million, you discount the cash in the hands of the company, or you add a premium for the cash? I want you to think about it, because I think there might be companies where you see 100 million in cash there. In this company's hands, that's really worth 80 million. What kind of company does that have to be? I want to talk about cross holdings. For me, the nightmare in valuation is your company with lots of cross holdings in other companies. We'll talk about how you'd value cross holdings in a perfect world. So we'll go through a series of things, but I'll at least leave you with the sense of where this part of the class came from. You know how academia works? I'll tell you. When any professor complains about how much they work, don't believe them. Here's what my life looks like. I have to teach 4.5 hours a week for like 30 weeks a year. And because I work so hard, I get the summer off. And then every 7th year, I get the 7th year off. It's very biblical. You work 6 years, you get the 7th year. It's called a sabbatical. So about 2006 or 7, I get a sabbatical. Usually people have big plans in the sabbatical. My plan on my sabbatical was to spend an entire year with nothing to do. And I got a little explicit about it. First day of my sabbatical, I get one of those to-do sheets from, Staples. I put it up on the wall at home. And as my kids come down to go to school, they were all at home then going to school. I said, kids have nothing to do today. Pissed them off no end. But then I made my fatal mistake. My wife came down the stairs and said, "Hon, I have nothing to do today." She said, "Really? Why don't you take the dog for a walk?" I take the dog for a walk, and there are 3 things on my to-do list. So what is this? Pick up bok choy at the grocery store. I didn't even know what bok choy looked like. I was too embarrassed to ask. It's ugly looking cabbage. I finally found it. But after about the 3rd or 4th item, I said, you know what? I need things to do to keep my wife off my list. Providentially, I open up my email. There's an email from the editor of CFA magazine, a magazine I've never read. I don't even know existed. He says, would you write an article for us? My first reaction, no, I'm nothing to do. Then I remembered I needed things to do. I said, yes. And I wrote a 1-page article. That's the only thing I've ever written that's got me hate mail. You know how difficult it is to get hate mail and valuation? Nobody says, I hate you for using bottom-up betas. Nobody feels that intensely about it. But part of the reason this got hate mail was the title of the article, Stop the Garnishing. And what I was talking about is the practice in valuation. After you value a company, you garnish. You add 20% for control, you knock 35% for liquidity. If you do that, you're going to end up where you wanted to be in the first place. And a bunch of hate mail, most of it is, you idiot, you whatever. And one of them says, if you think what we're doing is wrong in appraisal, why don't you come up with better ways of doing it? And I said, you're right. I have 11 months left in my sabbatical. So here's where my plans went out of the window. I spent each month focusing on another loose end. First month was about control. What's the true value of control? How would you value it? Then in liquidity. It's 1/2 of one of my books, The Modern Valuation. The second half of the book came out of the sabbatical. That's what we're going to cover in the next session, is those 9 months compressed into 60 minutes or so, or 80 minutes. But basically, that's what we'll talk about on Monday. I will see you on Monday.
Upstairs.